Hello students. Today in this video I will present to you about the impact of global conflict on the financial statements, especially in the reports of balance sheets. Therefore, the starting question: how the global conflicts affect the balance sheet reports in accounting. Conflicts thousands of miles away can directly change how companies report assets on today's balance sheet, because the geopolitical shocks affect asset values, liquidity, solvency, and disclosure requirements. For example, sanctions, currency instability, and supply chain disruptions force firms to revalue assets, adjust risk disclosures, and sometimes recognize impairments. Let us see the affecting factors one by one. First, the asset valuation. Under the asset valuation, let us see the sanctions and the restrictions. Here, assets in sanctioned regions may need to be written down or reclassified. Example, European energy firms had to impair Russian joint ventures after the Ukraine war. Another, fair value adjustments. Here, market volatility changes the fair value of securities, inventories, and property. Example, airlines revalued aircraft lease obligations when fuel prices spiked due to Middle East conflict. Let us see the second affecting factor, that is the liquidity and cash equivalents. Under this factor, let us see currency controls. What does it mean? Companies may lose access to cash held in foreign subsidiaries. For example, multinationals in Venezuela and Russia reported restricted cash balances. Another factor is the banking disruptions. What does it mean? It means conflict can freeze cross-border payments, forcing firms to disclose liquidity risks. For example, British Petroleum and the Shell Company reported impairments and liquidity challenges after exiting joint ventures in Russia due to the Russia-Ukraine war. Let us see the third affecting factor. The third affecting factor is solvency and debt reporting. Under this factor, we will see higher risk premiums and going concern assessments. What we do mean higher risk premiums? Conflicts raise the borrowing costs and the sovereign risk spreads. For example, the emerging market firms saw debt to equity ratios worsen when sovereign bond yields spiked after Middle East tensions. If you want to refer it, www.imf.org, Media Files Publication 2025. Going concern assessments here means the auditors may require disclosure of conflict-related risks to the long-term solvency. The fourth affecting factor is non-financial assets. In this factor, there are impairments in the insurance and the leases. Let us see the impairments. In the conflicting world, the factories, mines, or offices in conflict zone may be destroyed or inaccessible. For example, the mining companies in Africa and the oil firms in Iraq disclosed impairments due to the instability. Another one is the insurance and the leases. In the conflict world, the firms must reassess lease obligations and the insurance recoveries when operations are disrupted. If you want to refer in the web links in international accounting implications, you can refer it and approve. Another factor that is affected by global conflict is disclosure and transparency in reporting. Here, under disclosure and transparency, we will see risk reporting and events after the financial reporting period. First, let us see risk reporting. The International Financial Reporting Standards, that is the IFRS, and US GAAP, that is United States of America, Generally Accepted Account Principle, require disclosure of geopolitical risks affecting operations. For example, the banks in Iraq disclosed geopolitical risk exposure to improve the earnings quality and investor confidence. Please refer www.researchgate.net publication. That is the impact of accounting disclosure of geopolitical risks. Okay, another is the events after financial reporting periods. Here, the conflicts may trigger the subsequent events noticed in financial statements. Let us see the real-world examples which are related with the global conflicts and the effects on the balance sheet statement. Here we will see 4 companies. The first company is the British Petroleum and Shell Company. This company impacted in Russia-Ukraine war, and the balance sheet effect is asset impairment and exit from the joint ventures. The second company is Boeing and Airbus. This company impacted in Middle East conflicts, and the balance sheet effect is lease revaluations and higher fuel-linked liabilities. The third one is the JP Morgan Chase. This company impacted in global geopolitical risks, and the balance sheet effect is expanded disclosure on sovereign risk and the liquidity buffers. The fourth one is the Coca-Cola Company. This company impacted in Venezuela sanctions, and the balance sheet effect is restricted cash balances disclosed. Let us see the specific balance sheet report. Here we are discussing about balance sheet effects because of the geopolitical or global conflicts. As we know, balance sheet report elements or the items that are included in the balance sheet are assets, liabilities, and equity or capital. Therefore, the balance sheet equation, or what we call the basic account equation, is assets is equals to liabilities plus equities. Therefore, from the beginning of our discussion, the most affected items in the balance sheet are the asset sections, and their asset valuation is main factor that is affected. Here, let us see the value of assets before the conflict and after the conflict. Here, cash and the cash equivalents before conflict value is $500,000 and after conflict reduced to $400,000. Accounts receivable before the conflict $300,000 and after the conflict it is reduced to $250,000. Inventory before conflict $200,000 and after conflict reduced to $180,000. Property, plant and equipment before the conflict $1 million and after the conflict $950,000. Investments before the conflict $400,000 and after the conflict $300,000. Therefore, the total asset before the conflict $2,400,000, but it reduced to $2,080,000 after the conflict. This shows the reduction of asset values after the conflict. Let me analyze the impact on the balance sheet report. First, let's see asset valuation, because asset valuation is the most impacting factor in the balance sheet. Here, due to the conflict, the value of investments, the value of property, and the other assets has decreased, reflecting market instability and the geopolitical risk. Another one is the liquidity ratio. Liquidity cash reserves have diminished, possibly due to increased operational costs or precautionary measures. Here, liquidity ratio calculated by dividing liquid assets by its short-term liabilities. Liquid assets means current assets divided by its short-term liabilities is liquidity ratio. Therefore, it is also affected or impacted. Another one is solvency. Yes, another one is solvency. What is solvency, by the way? Solvency is the organizational capacity to pay off long-term debt from its assets is known as solvency. Therefore, the reduced asset values affect the company's debt to asset ratio. That is impacting its solvency ratio. Another one is the disclosure adjustments. International financial reporting standards need the companies must disclose risks related to geopolitical tensions in their financial statements, including the potential impairments and the contingent liabilities. Why? Because this makes the report very transparent. Therefore, disclosure adjustment take place, or that matters. Okay, let us see the key decisions that the users could make by seeing report after conflict. The first decision they can make is the investment decision. Reduced investments and the property values and the other asset values, the investors may decide to divest from higher risk regions, or they shift their capital into safer and more stable markets. This is the first decision, that is investment decision. Another is portfolio rebalancing. That means the investors move funds from volatile assets. For example, volatile assets, example, foreign subsidiaries, energy projects in conflict zones are volatile assets. Therefore, they move into safer assets. Safer assets like government bonds and domestic ventures are safer assets. These are some of the investment decisions that the users of financial report, especially balance sheet report, can make. Another decision is the liquidity management decision. And this decision, because of the lower cash and receivables, the managers may decide to tighten credit policies, to accelerate collections, or to secure emergency financing. These are the liquidity management decisions. Another is cash preservation. Cash preservation. Here the firms may cut the dividends, and they may delay the expansion plan or renegotiate supplier contracts to conserve liquidity. These are the liquidity management decisions they can make. Another one is the solvency and the risk strategy decisions. Here, because of the weakened debt to asset ratios, the creditors and the lenders may reassess their lending terms and conditions. They may increase interest rates or they reduce exposure. Another in this decision area is management response. Here the companies may restructure debt, may they sell non-core assets or seek government support to maintain solvency. These are some decisions that users of financial report can make after seeing the balance sheet report. Another area of decision is the operational adjustment decision. Due to the inventory decline, this inventory decline indicates the supply chain disruption. Firms may diversify suppliers, may increase local sourcing, and they may build buffer stock. Another decision area is property impairments. This may lead to decisions about relocating operations, ensuring assets differently, or exiting conflict-prone regions. These are some decisions. Another decision area is the disclosure and the transparency decision. Under this, conflict-related notes. Here, the users include the investors, regulators, auditors. They may demand the greater disclosure of geopolitical risks and contingent liabilities and subsequent events due to the International Financial Reporting Standard rule. In this decision area, another one is decision impact. Decision impact means the stakeholders of the company may adjust confidence in management depending on how transparent the reporting is. Okay, these are the key decisions that the users of balance sheet could make after seeing the balance sheet report. Let us conclude today's presentation or today's discussion. In this presentation, you understood that the geopolitical conflicts directly influence the financial reporting, especially the asset valuation, the liquidity ratios, solvency ratio, and the disclosure adjustments in the analysis part. You also understood the sample balance sheet before conflict and after conflict. That means the balance sheet before conflict shows a company's financial position under the stable conditions, but the balance sheet after the conflict reveals reductions in cash, receivables, inventory, property, and investments. Why? Due to the conflict-driven risks. And lastly, you understood that the possible decisions that the users of financial report, especially the users of the balance sheet report, could make after seeing the second report. Here, the second report means the financial report or the balance sheet report after the conflict. Thank you for your listening and watching this video. Please subscribe, share, and like.